good ship probably involves some sort of playing the cycle. Clearly, you also need to be a keen operator if you want to survive the cycle. But positioning yourself at the right point is obviously making the right investment decision is a key part of the success. We started this panel with 4 participants, but apparently the answer to the question is too difficult, and we ended up with 2. So I welcome Vafias, the CEO of StealthGas, and Saroglou, the COO of TEN. The first point I'd like to discuss is the perennial question is, new building or second hand. And obviously, each has his own answer, depends on the philosophy, depends on the market. Harry, would you like to give us your view? Your segment clearly has a very particular dynamic. It's not typical bulk shipping, but how do you feel about that?
I'll speak generally, not about my segment, because I don't think a lot of people want to know about my segment. They probably want to know more about the typical dry or wet or container segments. I think that in today's environment where you have, we are just after a huge ordering spree of the late 2000s on all segments, dry, wet and containers. I'm a bit sad to see that there's a new wave of ordering dry, product tankers and containers in a smaller scale. So I think that if we see better markets and better freight rates and a balance, we need to do 2 things. Scrap more ships, not be tempted to order new buildings, and the people that have the money and want to invest, there are plenty of good second-hand ships, modern and older, that you can buy at quite attractive prices, so you can invest there, bet on the market and not overburden the market with more new buildings.
So am I to understand that you don't buy, quote unquote, for the general bulk shipping, the market, the eco design of the shipping? Because I guess one of the reasons why people tend to go for new buildings is that they think that it will make a material difference at the end of the day for the charter.
It all depends who is saying it. If you have a very good and established yard, maybe 90% of what they say is true. When you have a less experienced yard or a greenfield yard saying the same thing, I guess you should be very, very wary about what they state. On the other hand, a lot of very well-known and established companies with 30, 40 years in shipping like AP Moller or Danaos or others are saying that the eco hype is well overstated, and they are doing their own modifications on the existing ships and getting almost eco consumptions. So again, we go back to what I said before, buy a good second-hand ship from a good yard, do the modifications, and you've got yourself an eco ship, and you don't have to wait 2 years about it, 2 years to get delivery.
Mr. Saroglou, do you share this? You've been very conservative in terms of new buildings as TEN. You have avoided the too many expensive vessels, and you've been quite conservative. But yes, to the extent you can comment, would you expand right now in either direction?
We share the view that Harris has expressed. And yes, I think we're a little bit also lucky that we expanded the company during a period of time when new building prices were just starting to rise, value started to rise. Today, if we look at the sectors in which we operate, which is LNG, shuttle tankers, product and crude tankers, clearly of the 4, the first 2, the LNG and the offshore, are doing very well. And the fundamentals of these markets for the next 5 years seem to continue to be very well. The rest of the product, although the market seems to have stabilized and we are seeing improvement in the freight rates, I think this eco frenzy with a lot of ordering could really reverse the trend. It could kill the market if it continues. While on the crude sector, I mean, this is the sector that we still have, especially on the larger size, like the V's and the Suezmaxes, the highest new building. The order book is still quite high, but the good thing is it is coming down. And as it is mentioned here, the crisis that we are currently facing is not a demand-driven crisis, because demand has recovered after 2008 and 2009, and demand for oil is at record levels. It's more a supply-driven crisis, and this is a crisis that ourselves have inflicted on us.
Just to add to Mr. Saroglou, I think that Ben made the right decision to invest in new segments and not be trapped in let's say, the typical tanker segments that are now suffering because of over-ordering. And the segments are obviously LNG and the shuttle tankers. And if I was in their shoes, I would from now on try to grow that segment of the fleet in order to have more eggs in more baskets.
Makes sense. The fact is that obviously the cash flows right now, especially on the crude side, but also on the dry, they're too low, but prices haven't gone, I think, down as much as to justify still the cash flow. So there are some people who say that the best opportunities into entering this market are not necessarily through hard assets, but through paper investment. Now, paper investment might be bonds, might be buying portfolios from banks, given that a number of banks are exiting, but not enough are re-entering the market. Do you have a view on that? I mean, do you feel that paper investments might present better opportunities? And that is a question not obviously as a company itself, as an investor rather than
yes, I do agree with you. In some cases, paper investments might make more sense time-wise and price-wise than the actual assets. But don't forget, we're in Greece, and we are basically ship owners, and we like owning the assets.
Yeah.
So even if a paper investment looks cheaper on paper, we would go back to owning the actual assets.
Yeah, well, I totally agree, and especially if you're a public company and you operate in sectors that are not favored by the market, like in crude carriers, your share price is beaten down significantly. Not so much maybe because there are some issues with how you operate your fleet. It's more to do with general issues and the restructuring that we have seen in the last few years, and the issues that big names in the industry have faced. Nobody, for example, expected OSG to go through a Chapter 11 reorganization, and in the minds of the market and the analysts in New York, when a company like OSG goes down, the next question is who's next, and therefore that has a significant effect on your share price. Without your actual business, you still operate in a market that is challenging, but maybe you're doing very well, but you have also to counter the fall in your share price. And then when you talk to investors, everybody's saying to you, why you invest in ships when the best investment that you can possibly do is maybe buy your own stock. But we are ship owners, and when you're a ship owner, you have to service the requirements of your clients. Therefore, you need to buy ships if the requirement is there. You need to always operate, if that's your, let's say, mentality to operate a modern fleet, so you need to sell the older vessels and replace it with newer vessels. And this is something that we're trying to explain to fund managers who sometimes, have a different view on how you have to play the low cycle that we're in.
Thank you. I had a discussion recently with 2 or 3 different privately held companies where the principal was quite cash-rich, and given also the difficulties that the banks have to extend new credit, and also the cost they offer this credit when they are able to extend it, he or they were of the view that it's even better to buy vessels now cash and leverage later on. Would you share this view?
In today's environment, there are very few owners that can buy ships in cash.
I agree.
Unless you're talking about 25-year-old twin deckers. If you're talking about high-quality modern ships, because of the cash burn that many owners have suffered since 2009, it's not that they don't have the money to buy a ship cash, but they need the cash to support the existing fleet. So I don't think many owners at the moment have the luxury of deciding if they're going to buy cash or not. The idea is to try to keep your cash for a rainy time like now, and therefore try to find finance, even if 70% of the banks are not lending today.
Which I guess begs the next question: if banks are not lending, we've seen alternative sources of financing, and more discussion will be held on that in the next sessions. But have you had any experience of this alternative source of funding, and do you think that they have been through the learning curve? Do they understand better what shipping is about? How the numbers work? What is the time horizon for an investment? Do you think they are closer to the reality of shipping?
Okay, we and TEN are lucky because we're both listed. Therefore, if we need money, we have a good track record. We go back and we raise money from our shareholders. But if you're a private company, I think that in the last 1 year, we've seen a lot of well-known companies teaming up with private equity. You have the example of Prime with Perella Weinberg. You have the example of Costamare with York. You have the example in a much smaller degree of Euroseas with Rhone. You have the example of Elletson with Blackstone. You have so many examples. Therefore, if you're talking about the typical mainstream segments, dry, wet and containers, yes, I think they have the knowledge and the expertise. Now, if you go to more exotic segment like LNG, LPG, drills and stuff like that, I don't think they're yet to that point.
I agree with you. The question, I guess, is whether the pricing they're offering will prove to make sense. But I guess that will come. The answer to that will come with time. Whether their expectations will be met and whether they.
It depends how much you need the money. If you need, I know of companies that need the money very much, and therefore they will swallow anything that the private equity funds tell them. And I know of private companies that don't need the money, so they say to the private equities, these are the terms. If you want to be partners with us, take it. So I don't think there's a standard price. It all depends on the strength of the existing company. Yeah.
And a lot of these private equity funds, they want to invest in shipping because they understand that this is a sector, this is a business which is suffers right now from overcapacity. So there is some distress. And but if their attitude when they come to try and find the right partner, the right shipping partner with whom they will build their portfolio is that they are looking for a distressed partner, then I think there is very little possibility to join hands and to do the business together. If they look for a partner that is knowledgeable and maybe they will somehow share parts of, they will share the control and the rewards, then there is a possibility for these private equity people to team up with shipping people. But I think my personal view is, because we've talked to many people, being public, you see everything that is out there. A lot of these private equity funds still have in their mind, very high returns, quick returns, and also control issues that if they don't fit in your own, let's say, profile that you have as a shipping company, then you're not there to take on the returns.
So what would be the best scheme on a private company? What do you think that there is an optimum scheme from the shipping point of view that would be more easily targeted by such a investor? I mean, the traditional Greek shipping structure is that, you know, a bunch of SPVs, management company, which is not necessarily open to such sort of investment. There is clearly a trend towards a corporatization of Greek shipping. Do you see that happening so as to attract such investors? Or?
I think, as Harry said, depends very much on the needs of and the culture of the shipping company who wants to team up with these private equity people. For some people, it's a no-go. For some others, you know, sharing control or giving control is no problem, and they prefer to, you know, build something together rather than do it on their own. And maybe on their own in this market they cannot do it. So it's a choice that every shipping company, you know, takes for themselves. There's no recipe, as far as I'm concerned.
Shall I open up to the participants? Would you like to make any follow-up questions on the issue of time of investment, of choice of investment, of vehicle of investment? Ladies first.
Thank you for that. Saroglou from White Shipping. Since I represent a shipbroker, can you tell us what you would invest in today?
I think we would invest in LNG. If you get the chance, because we cannot, you know, and shuttle tankers. But in both of these asset classes, you have to be patient. You cannot say that you will be able to, let's say, every quarter or, you know, every 6 months to have a couple of vessels coming into the fleet. So these are the sectors that we look at now.
Just to add on that, you buy everything that the others don't buy. So everybody buys dry, you buy LPG, LNG, everybody buys tankers, you buy supply ships. You buy into segments that are under the radar, the order book is smaller and demand is steady to growing. And if you see which companies have done well over the crisis, it's very easy to see which companies these are. It's either companies with no debt or companies in specialized segments.
Do you think, though, that shareholders, if you talk about listed companies, have the stamina or the patience to support this counter-cyclical event? Because what you say makes absolute sense. But have you, from your experience, have you seen shareholders support this counter-cyclical or contrarian, however you want to call it, investing pattern?
Shareholders don't like, generally speaking, mixed companies. They don't like a company to have 3 Aframaxes, 2 product tankers, 1 VLCC, 1 LNG and 1 drill ship. They like to be pure plays. Mm-hmm. So if you're a pure play, let's say in LNG, and today you really believe that it's the time to buy, even if it's a contrarian view and the rates are still not there, I think they will understand and will agree with you. The investors in the US have become very knowledgeable in the last 2 years, especially after the bad times. They lost a lot of money, so they were forced to learn from their mistakes. So what I've seen, and I think George can also add to that, is that they like contrarian stories, they like new stories, they're fed up with hearing the same segments, and unfortunately for both of us, because we both have mixed fleets, they prefer pure plays. So I think that TEN might consider a spin-off. I think it's a very good idea. And we might spin off our tankers in StealthGas. So we have to, because the investors today do not like having mixed baskets. They want to buy StealthGas for gas, they want to buy TEN for tankers, they want to buy somebody else for dry. They don't want mixed baskets.
They want to use the decision not to you on their behalf. Yes.
There's clearly a discount if pure versus, let's say, a mixed bag. And depends also on some other factors like, let's say, the track record that you have as a public company, the operating story that is behind you, you know, your time charter strategy, your commercial strategy, etc., etc. But I mean, in today's, and I'm not necessarily against pure plays, because it's easier, I think, for both investors and the analysts to understand pure plays. But if, for example, you have, in our case, just to give now an example, right now we have 49 vessels and we have a market cap of less than 300 million. So if you split the company in two, products and crude, then I mean you create two smaller companies of 150 million, which is very difficult and maybe not of interest to investors to follow and for analysts to follow. So you're in a bit of a trap. You need to grow your valuations to go over, let's say, from 300 million maybe to 500 million, and from there a bit higher before you're actually able to, let's say, do any sort of split or spin-off and therefore create two units that might have, the markets appeal. Yeah.
Yes, in fact, you kind of answered the question I was going to ask you, because my question was going to be about mixed fleets versus pure plays. And you answered it in a contrarian way, because I was going to come at it from the angle that without being in that business, of course, I just had a kind of sense that perhaps investors in the US were becoming a little bit more used to the idea of mixed fleets, because if you'll allow me 1 minute to go on and expand the comment, seeing as you've already partly answered the question, they were always in favour of pure plays, but now one sees, partly by force of circumstance or because of particular situations in tackling some issues that companies have, that you actually do have apparently successful cases of mixed fleets that seem to be getting fairly healthy support from analysts and investors. Your companies are to some extent examples of that, but I was thinking perhaps more of examples like Capital, which is clear, has really spread out into a company where you have a real mixed fleet, i.e. you've got a bit of dry bulk tonnage, you've got product tankers, and you've got crude carriers, and now container ships. Vafias as well, where there's quite a lot of cross-shareholdings between dry bulk, now tankers, and the first container ships as well. So that was the basis of my question, and I'm really wondering whether there was a little bit more acceptance of the mixed model, in the traditional way that Greek ship owners, private Greek ship owners, hedge their bets, because perhaps in the old days one thought that the wet and the dry markets wouldn't go terribly bad all at the same time. A principle which has now been completely disproved, but that's part of the basis to hedge your bets.
Yes, Nigel, as you know well, MLP is not considered a typical company. MLP, you buy the shares of an MLP just for the dividend. So you don't care if the MLP owns dry or wet or drill ships or containers or fish boats. They want the dividend. So on that comment, yes, Capital has done a good job. Where one segment is weakening, you switch or you add ships of another segment to keep up with the dividend. So on that I agree. On what I don't agree is about the typical listed shipping, the non-MLP ones, which unfortunately, because both us and TEN are mixed, we both get a discount for being mixed fleets. I had many shareholders that told me, please sell the tankers even at a loss to become a pure play, and I'm sure because we share common shareholders with TEN, I'm sure they've heard the same. Imagine that on the private side we have both crude and product tankers, and a lot of potential shareholders or investment banks have told me don't even consider doing an IPO with those ships altogether. You have to split even the tankers into crude and products. And one more thing about hedging. the shareholders, the investors, want to hedge their own bets. They don't want you to do the hedging. So, for example, they buy a dry company because they want to play dry, and at the same time they buy an LNG company, so they hedge their own bets. They don't want the dry company owning 3-4 different segments. And last but not least, Navios is basically pure play, because it's Navios with the dry vessels, if I'm not wrong, it's another Navios with the tanker vessels, and it's another Navios with the port. So, it's a pure play. I don't think Navios is a mixed company.
Well, thank you all. Thank you for your comments, your insight. We may have had a panel that went from 4 to 2, but we'll have a presentation that went from 1 to 2 also. So we have next a presentation on the shipbuilding industry. First, let me thank the participants. You're most welcome to stay here if you want. We'll have from Tsakos Maritime, but also I understand Mr. Fallon